A lot of what we do in risk control and risk assessment has to do with identifying risk factors and assigning risk sensitivities. So in the world of the CAPM, there's one risk factor, and that's the market return. In an international context, that's the world market return. And the risk sensitivity is the beta. And the beta tells us, on average, how the stock moves when the market moves. So we need first to distinguish between the risk factor and the risk sensitivity. Well, what we usually do is to go beyond this one factor CAPM type of analysis. And the question is, what are the risk factors that are relevant for international investment? And the place that I start usually is I start even looking within the US. And it's rather interesting to notice that if you look at people that study exclusively fixed income, they've got a very good idea of what the risk factor is for fixed income and the risk exposure. Use a measure of duration. And duration tells us the sensitivity of the fixed income return to a change in the interest rate. So in fixed income, the underlying factor is the change in the interest rate in the economy. And the duration is the risk sensitivity. Now, there's one critical point here. Just because some asset has some sensitivity to some variable doesn't mean that that sensitivity is a risk sensitivity, and it doesn't mean that that variable is a risk factor. There's something else that has to happen. For risk to be risk, it needs to be rewarded. If I take on more risk, there should be a higher expected return in return for taking that risk. So even if there's a significant relation between an asset and some variable, that doesn't mean that that variable is a risk factor. And the way that we actually check this out is to look at the risk sensitivities to see if they explain the differences in returns. And going back to the fixed income example, it's a very good example because the durations, which are risk sensitivities, explain the differences in the average returns for different fixed income instruments. If you've got a low sensitivity or low duration, a very short-term instrument, like a treasury bill, that's got a lower average return than a 30-year government bond that's got a much higher duration. So in the study of fixed income, their factor is changes in the interest rate. Well, in equity, our first factor is the change in the market return, or the change in the market price. Now, it seems to me that one logical factor to look at would be some sort of interest rate sensitivity for equities also. There's no reason not to have a duration-like measure or a beta against interest rate changes. So that's usually the first thing that I would look at. And just as an aside, it also makes sense for corporate bonds especially to look at their beta with respect to the overall market. Because corporate bonds, especially high yield bonds, are sensitive to what happens in the market. Now for international, we will go beyond this. And we go beyond this in even the analysis of domestic equities. That one interest rate is not enough to value a bond, and it's not enough to value an equity. So what people often look like are different measures related to interest rates, like the whole term structure of interest rates. So term structure and the rate is important. Often we go behind the rate and figure out what the fundamental forces are. For example, the nominal interest rate is composed of an expected real interest rate, which is likely affected by expectations of real economic growth, and an expected inflation component. So, two additional factors that could be important are some sensitivity to economic growth and some sensitivity to inflation, whether it's change in the expected inflation rate or unexpected inflation. The other thing that is actually determined by interest rates is the foreign exchange rate, which is obviously important for international investment. So often we will look at the exposure of a country to a basket of currencies relative to a numeraire like the US dollar. Now here's where it gets a little confusing. The risk factors that I've been talking about are factors that are common for all countries. In integrated capital markets, we will look at the world market return, representing the capital asset pricing model. We will look at a change in an interest rate that is a weighted world interest rate. We will look at the exposure to a world inflation rate. We will look at an exposure to a world measure of industrial production growth. And finally, we will look at the exposure to the change in the value of a basket of currencies relative to the US dollar. And you might say, well, what about the local information? What about the local inflation rate in that country? Isn't that a risk factor? No. The local inflation rate is more likely reflecting the risk sensitivity. So really what we've got here are variables, characteristics within each of these countries. The local interest rates, the local inflation, that likely affect the betas. They're not the risk factors, but they affect the sensitivity of the country to these pervasive world factors. And this is how we go and construct a world factor model where we estimate sensitivities for each country, and what we're able to do is to determine the exposure of the portfolio that we've constructed in the general framework of risk control.